It's 6:23 on a Thursday morning in a quiet neighborhood just south of Knoxville, Tennessee, and Harold is sitting at his kitchen counter with a single sheet of paper that arrived in yesterday's mail. The overhead light casts a pale yellow wash across the page, and his reading glasses rest halfway down his nose as he stares at a number printed in bold near the bottom of the statement. The number reads $738,400, and it represents the inherited IRA his mother left him when she passed away 14 months ago. He hasn't touched a single dollar of it because every time he thinks about withdrawing, something in his gut tells him to leave it alone and let it grow. The coffee maker behind him clicks off, but he doesn't move. His index finger hovers just beneath the balance line, tracing the number as if reading it one more time might change what it means. He knows there's a rule about inherited IRAs, something about 10 years, something his mother's estate attorney mentioned in a sentence he barely absorbed during the worst week of his life. His chest tightens slightly because he has a growing feeling that doing nothing may not actually be the safe choice he assumed it was. The paper sits perfectly still on the counter, but the weight of the decision it represents is pressing down harder each month. Harold's situation is far more common than most people realize, and it's playing out right now in households across every state in the country. Since 2020, a change in federal law restructured how inherited retirement accounts must be distributed, and the majority of beneficiaries have no idea what that change actually requires of them. The rule has a name, but the consequences it triggers are what most families never see coming. This is not a minor paperwork update. The inherited IRA rule under the Secure Act is quietly reshaping how generational wealth moves through families. And in the next few minutes, you're going to see exactly how it works, what it costs, and what you can still do about it. By the end of this, you'll understand how the 10-year rule actually operates and why delaying withdrawals is one of the most expensive mistakes a beneficiary can make. You'll see how inherited IRA distributions interact with your existing income to push you into higher tax brackets you weren't expecting. You'll learn how to structure annual withdrawals so that you spread the tax impact across years instead of absorbing it all at once. And you'll walk away with a set of concrete steps you can apply to your own inherited account before the end of this calendar year. You don't need a finance degree or a background in tax law to follow what comes next. You just need to stay focused and be willing to look at numbers that most people avoid. Retirement changes the entire structure of how money flows into your life, and inherited accounts add a layer of complexity that most people never planned for. During your working years, income arrives on a schedule, taxes are withheld automatically, and the system runs largely on autopilot. Once you stop working, or once you inherit a large retirement account from a parent or spouse, the decisions about when and how much to withdraw land entirely on your shoulders. There are three major types of accounts that matter here, and each one is taxed in a completely different way. If you've recently inherited an IRA or expect to inherit one in the next few years, this applies directly to your financial future, so think carefully about where your own accounts fall in this picture. Think of your retirement income as a recipe with several key ingredients, each one requiring a different temperature and cooking time to get right. If you pull one ingredient out too early or add too much of another all at once, the result is a dish that costs far more than it should. The inherited IRA is the ingredient most people forget is even in the kitchen, and it can overpower everything else on the plate if you don't control the proportions carefully. The first type is the traditional IRA or traditional 401k, which is funded with pre-tax dollars, meaning you got a tax deduction when the money went in. Every dollar you withdraw from this type of account is treated by the IRS as ordinary income, taxed at your current marginal rate in the year you take the distribution. If your parent left you a traditional IRA, the same rule applies to you as the beneficiary, meaning every dollar you pull out adds directly to your taxable income for that year. Most inherited IRAs in the United States are traditional, not Roth, because the generation that built these accounts was contributing during decades when Roth options either didn't exist or weren't widely available. This is why the distribution strategy matters so much, because the tax bill follows every withdrawal you make. The second type is the Roth IRA or Roth 401k, which was funded with after-tax dollars, meaning the original owner already paid income tax before contributing. Withdrawals from an inherited Roth IRA are generally tax-free to the beneficiary, which makes them significantly easier to manage. However, the 10-year rule still applies, meaning you must empty the account within 10 years of the original owner's death, even if no taxes are owed. The difference between inheriting a traditional IRA and a Roth IRA can be enormous in terms of what you actually keep after the IRS takes its share. The third type is a taxable brokerage account, where investments are taxed based on capital gains rates rather than ordinary income rates. Long-term capital gains rates are typically lower, and inherited brokerage accounts receive a step-up in cost basis at the time of the original owner's death, which can eliminate gains entirely. Understanding how these three account types interact is the foundation you need before you can make any intelligent decision about your inherited IRA. And now that the ingredients are on the counter, it's time to talk about what happens when most people get the recipe wrong. The intuition most beneficiaries follow is simple and sounds perfectly logical on the surface. They assume that leaving the inherited IRA untouched for as long as possible gives the money more time to grow, which should maximize the total value. This reasoning works beautifully for accounts you own yourself, and it's the same logic that made the original owner wealthy in the first place. The problem is that inherited IRAs operate under a completely different set of rules, and the strategy that built the wealth is not the strategy that preserves it during distribution. The first consequence that catches people off guard involves federal tax brackets, and the numbers move faster than most beneficiaries expect. If you're a working professional earning $85,000 a year and you inherit a $700,000 traditional IRA, waiting until year 9 or 10 to take large distributions could force you to withdraw $350,000 or more in a single year. That withdrawal stacks directly on top of your earned income, pushing your total taxable income past the threshold where the 22% bracket ends and the 24% bracket begins, and potentially deep into the 32% bracket. A retiree or late career worker who might have stayed comfortably in the 12% or 22% bracket suddenly finds themselves paying marginal rates they've never encountered in their entire working life. The difference between paying 12% on a carefully planned withdrawal and paying 32% on a forced lump sum is not a rounding error. It's a shift that reshapes the entire value of the inheritance. The second invisible consequence lands in your Medicare premiums through a mechanism called IRMAA, which stands for Income-Related Monthly Adjustment Amount. Medicare uses your modified adjusted gross income from 2 years prior to determine your Part B and Part D premiums. And a large inherited IRA distribution can push you well past the income thresholds that trigger surcharges. Instead of paying the standard Part B premium, you could find yourself paying over $400 per month, and that elevated cost applies to every month of the surcharge year for both you and your spouse if you file jointly. Take a moment and run the numbers on your own situation, because if you took a large distribution from an inherited account last year or the year before, you may already be on track for a Medicare premium increase you haven't seen yet. The third consequence involves the taxation of your Social Security benefits, which is governed by a formula most retirees never examine closely. If your combined income, which includes half your Social Security plus all other taxable income, exceeds $44,000 for a married couple filing jointly, up to 85% of your Social Security benefits become taxable. A large inherited IRA distribution in a single year can easily push you past that threshold, meaning money your parents saved over a lifetime is now causing your own Social Security check to be taxed at a rate you never anticipated. This creates a cascading effect where one withdrawal triggers higher taxes on 3 separate fronts simultaneously. The recipe has gone wrong not because of any single ingredient, but because too much was added to the pot at the same time. Back in Knoxville, Harold is looking at exactly this kind of cascading risk without knowing it, because his mother's $738,400 traditional IRA is sitting untouched, while his own income, Social Security, and Medicare premiums are all connected to whatever he decides to do with it. He's been treating inaction as safety, but each year he waits compresses the timeline and increases the size of the future distributions that the 10-year rule will eventually force. His situation isn't unique. It's the default outcome for nearly every beneficiary who doesn't build a distribution plan in the first 2 years. The dominoes keep falling, and the longer you wait to line them up deliberately, the harder they hit when they finally tip on their own. The real cost of this mistake isn't visible in any single year. It accumulates quietly across the full 10-year distribution window and often extends into the Medicare premium adjustments that follow. Consider a beneficiary who inherits $600,000 in a traditional IRA and waits until years 8 through 10 to withdraw. If those withdrawals push $200,000 of additional income into years where the beneficiary is already earning $70,000, the math produces a federal tax bill roughly $48,000 to $62,000 higher than it would have been under a level distribution strategy spread across all 10 years. That isn't theoretical, it's arithmetic, and it runs in one direction. There's a window that most beneficiaries never recognize, and it sits between the year you inherit the account and the year your own required minimum distributions begin at age 73. If you're between 55 and 72, you may be in a period where your earned income has dropped because you've retired or shifted to part-time work, but your RMDs from your own retirement accounts haven't started yet. This gap creates unusually low taxable income years, and those years are the most valuable distribution years you will ever have for an inherited IRA. The majority of beneficiaries sail through this golden window without taking a single strategic withdrawal, then face compressed, high-tax distributions in the final years of the 10-year clock. Your lowest tax years are a finite resource, and once they pass, they don't come back. The counterintuitive strategy is to begin taking distributions from the inherited IRA immediately, even though it feels wrong to voluntarily create taxable income when you don't need the cash to live on. The goal isn't to spend the money. The goal is to move it out of the inherited traditional IRA and either pay the tax at a low bracket or convert the funds into a Roth IRA where future growth is permanently tax-free. The math behind this approach is straightforward, and it favors the beneficiary who acts early in nearly every realistic scenario. If you can pull $60,000 to $80,000 per year from the inherited account while staying within the 12% or 22% bracket, you avoid the bracket compression that punishes beneficiaries who wait. Spreading the tax across 10 years at lower rates will almost always produce a better outcome than concentrating it into 2 or 3 years at higher rates. Each dollar you convert or distribute from the inherited IRA in a low-income year is a dollar that will never generate a required minimum distribution from your own accounts, never trigger an IRMAA surcharge, and never push your Social Security into the taxable zone. When you move inherited funds into a Roth IRA, those dollars grow tax-free for the rest of your life and can be passed to your own heirs without the same 10-year clock resetting on a traditional balance. The Roth conversion essentially breaks the cycle that the Secure Act created, turning a forced distribution problem into a voluntary optimization opportunity. You pay a smaller, controlled tax now to eliminate a larger, uncontrolled tax later. The core insight is this: the 10-year rule doesn't punish you for inheriting money. It punishes you for distributing it badly. The beneficiary who spreads withdrawals across the full decade at favorable tax rates keeps more of the inheritance than the one who waits and lets the calendar make the decision. Ask yourself right now which tax bracket you're sitting in this year, and whether you've been filling the lower brackets strategically or letting them go empty while the inherited IRA continues to grow into a larger future tax bill. Voluntary taxes today at rates you control will always beat involuntary taxes tomorrow at rates the calendar imposes. That's the quiet truth at the center of every inherited IRA decision. Patricia is 61 years old, recently retired from a career in hospital administration outside of Charlotte, North Carolina. She inherited a traditional IRA from her father worth $542,800, and she has her own traditional 401k worth $310,000, a small Roth IRA with $47,600, and a taxable brokerage account with $88,000. Her Social Security benefit, which she plans to claim at 62, will be approximately $1,870 per month. Her annual living expenses run about $54,200, including property taxes, insurance, and a modest mortgage payment with 4 years remaining. Patricia decides to leave the inherited IRA completely alone for the first 7 years, drawing her living expenses from Social Security and her taxable brokerage account while waiting for the inherited balance to grow. In year 8, the inherited IRA has grown to roughly $680,000, and she's forced to begin pulling $226,000 per year across the remaining 3 years to empty the account by the deadline. Each of those withdrawals stacks on top of her Social Security income, launching her into the 32% federal tax bracket and triggering IRMAA surcharges on her Medicare premiums for 2 subsequent years. Over those 3 years, her combined federal and state tax bill on the inherited IRA distributions totals approximately $157,300, and her Medicare premium surcharges add another $9,400. If your situation looks anything like Patricia's, if you've been letting an inherited IRA sit untouched while the years tick by, you're not alone. But you need to understand that this delay has a specific and growing dollar cost attached to it. Daniel is 62, a former civil engineer who retired last year from a firm in suburban Denver, Colorado. He inherited a traditional IRA from his mother, worth $528,000. Has his own traditional 401k with $285,000. A Roth IRA holding $63,500, and a taxable brokerage account worth $104,000. His Social Security benefit at 62 will be about $1,940 per month, and his annual expenses are $52,800. Daniel starts taking distributions from the inherited IRA in year 1, pulling $54,000 per year, which is roughly 1/10 of the balance, adjusted slightly each year for growth and remaining balance. He covers his living expenses with a combination of Social Security, small taxable account withdrawals, and a portion of the inherited IRA distributions. Each year, his total taxable income stays within the 22% federal bracket, never crossing into the 24% threshold. By spreading the inherited IRA across all 10 years, his annual federal tax on the distributions averages approximately $11,370, and his cumulative federal tax across the decade totals roughly $113,700. He avoids IRMAA surcharges entirely because his modified adjusted gross income never breaches the threshold in any single year. His total tax savings compared to Patricia's compressed approach on a nearly identical inheritance is approximately $53,000 over the 10-year window. Daniel also uses the gap between his inherited IRA distributions and the top of the 22% bracket to convert $18,000 to $22,000 per year from his own traditional 401k into his Roth IRA. Over 10 years, he moves roughly $200,000 into the Roth, paying tax at 22% or lower on every converted dollar. When his own RMDs begin at 73, his traditional balance is significantly smaller, which means lower required minimum distributions, lower future taxable income, and continued avoidance of IRMAA and Social Security taxation cascades. The math across his full retirement, not just the inherited IRA decade, projects an additional $31,840 in lifetime tax savings from the Roth conversions alone. If your income is lower this year than it's been in a long time, this is exactly the kind of window that closes without warning. So the question is whether you still have room in your bracket to do the same thing before December. The projected difference between Patricia's approach and Daniel's approach over a 20-year retirement horizon, including the compounding effects of Roth growth, avoided IRMAA, and reduced Social Security taxation, exceeds $120,000 in total after-tax wealth. That number comes from two people with nearly identical starting positions who simply made different timing decisions about the same type of account. The recipe was the same. The difference was entirely in when and how much of each ingredient went into the pot. The first thing to do is locate every document related to the inherited IRA, including the death certificate date, the account custodian's contact information, and the beneficiary designation form. Call the custodian and confirm the exact deadline for your 10-year distribution window because the clock started on the date of the original owner's death, not the date you found out about the account. Ask specifically whether the account requires annual distributions in addition to the 10-year emptying deadline, because IRS guidance after 2024 requires annual RMDs from inherited IRAs if the original owner had already begun taking their own distributions before passing. The second step is to map every source of income you expect for this calendar year, including Social Security, any pension, part-time work, rental income, and investment dividends. Add those together and compare the total to your annual living expenses to see the gap between what you need and what you're already receiving. That gap tells you how much you need to withdraw from accounts anyway, and the question is which account it comes from. Your goal is to arrange withdrawals so that the inherited IRA distributions fill up the lower tax brackets before anything pushes you into a higher one. If your total income before inherited IRA distributions sits in the 12% bracket, you have room to pull from the inherited account up to the top of that bracket without any bracket jump. The third step is to fill that bracket space strategically each year, withdrawing from the inherited IRA up to the boundary of your current bracket and considering a Roth conversion with any remaining space between your total income and the next bracket threshold. If you're in the 12% bracket with $20,000 of room before the 22% line, a $20,000 distribution from the inherited IRA costs you $2,400 in federal tax, far less than it would cost in year 9 when it might be taxed at 32%. Review your situation before December 31st each year, because tax brackets reset on January 1st, and unused bracket space vanishes permanently. Before this year closes, you owe it to yourself to sit down with a CPA or fee-only financial planner who can model your specific numbers across the full 10-year window and beyond. The fourth step is an annual review, ideally in October or November, where you compare your year-to-date income against the bracket thresholds and decide whether additional distributions or Roth conversions make sense before the year ends. Tax planning is not a one-time event. It's a yearly adjustment based on what actually happened in your financial life over the preceding 10 months. Bring your inherited IRA statements, your Social Security benefit letter, and your prior year's tax return to a qualified CPA or financial planner who understands retirement distribution strategies. The cost of that consultation is a fraction of what a single poorly timed distribution can cost you in taxes, surcharges, and lost Roth conversion opportunity. Back in Knoxville, Harold still has time, and that's the most important thing to understand about his situation and about yours if you find yourself in the same position. He inherited the account 14 months ago, which means he has nearly 9 years of distribution window remaining, 9 years to spread the tax burden across lower brackets instead of concentrating it into a catastrophic lump sum at the end. If he starts this year pulling $75,000 annually from the inherited IRA while his own income is modest, he can keep his federal rate in the 22% bracket and begin converting portions of his own 401k into a Roth simultaneously. The recipe works when you control the temperature across the whole cooking time, not when you crank the oven to maximum in the final minutes and hope the dish doesn't burn. Harold's mother built that $738,400 over decades of careful saving, and the best way he can honor that is by distributing it with the same patience she used to build it. The recipe for preserving an inherited IRA isn't complicated, but it requires you to add the ingredients in the right order and at the right temperature across the full 10-year window. Rushing the process or ignoring it until the timer is almost up produces the same result: a tax bill that consumes far more of the inheritance than it ever needed to. The families who keep the most are the ones who started measuring early, adjusted the seasoning each year, and never let the pot boil over. Your parents didn't save this money so the IRS could take a third of it in a single year. If you're currently holding an inherited IRA and haven't started planning your distribution strategy, drop a comment below with how many years you have left on your 10-year clock, because the answer shapes everything. If this changed how you think about your own inherited account, a like helps other families in the same situation find this before their window gets any shorter. The best time to build this plan was the year you inherited. The second best time is today.